Today, we answer a big first-time homebuyer burning question. See, for the past few years, interest rates have been tippy top of mind for every prospective first-time homebuyer. So the question I've gotten a quadrillion times is this one. How do I shop for the best lender and the best interest rate? The answer is you don't. What you're shopping for is a financial consultant and advisor. You see, when people ask, how do I shop for the best lender and the best interest rate? What they're really asking is, how do I get a home loan to make this purchase as affordable as possible for me? So the answer to that question comes long before you ever start looking at homes. And unfortunately, most people don't ask that question early enough in their home buying process, because the answer comes when you discover all of your purchasing options with a first-time homebuyer specialist and advocate. Someone who's going to lay out for you everything that you can do today. And then when you're looking at that, if nothing really fits right now into your affordability, then they're going to help you build a plan so that you can achieve the best complete loan package for you. They're going to coach you for months, even years ahead of time. And they're going to give you so much more than a low interest rate. They're going to help you build a strategy. Getting the best deal with a loan for your home purchase, it is so much more than that one little number of the interest rate. A true deal, it's personal, and it has to be custom sculpted to your entire home buying plan. And in fact, even when you're just looking at the interest rate, that one little number has so much packed into it to determine whether it's the best number for you. You're going to be looking at things like points and lender fees attached to it, your interest rate versus your APR. And then when it comes to the entire loan package and figuring out what rate, what loan program, and what full package is best for you, you're going to be looking at your available cash, choosing the program that fits all of your short-term and long-term goals, your monthly budget, the cash reserves, your down payment strategy, your other savings and retirement vehicles, your timeline, your job stability, and of course, all of your financial and personal goals for the next 10, 20, 30 years. And those of you who've been listening for a long time, you know that I empathize. It's tough to buy a home. It's a confusing conundrum of information. And so a lot of times people like to grab onto that one thing that feels comprehensible to them. That one little number, that makes sense. So what we're going to do today is we're going to break down all things loans, rates, and getting you what you're really trying to figure out, your best affordable option in 2026. And we're going to bring in the queen, our one and only nationwide unicorn lender, Kelly Cort. Let's go.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
All right, How to Buy a Homies, I'm very excited about this one because it's a brand new year here in 2026. I'm getting a lot of people that are getting excited, but I keep hearing the same thing. Oh, I still got to do this and I still got to do that before I waste a realtor or lender's time. And when I hear that, it just makes my heart sink, because the best way for you to get prepared is to start early. And once you get started early, you're not going to have as many questions throughout the process, but most importantly, you're going to have the planning and the strategies created. So I have a very special guest today. Our one and only unicorn nationwide lender. I've got Kelly Cort from Guild Mortgage, who has helped me develop the whole How to Buy a Home and bring you guys the free education and empowerment that you need. And we're going to get into some details, including why you shouldn't wait. Kelly, say hello to the How to Buy a Homies.
Hey, homies. I am so honored to be here. I am so honored to be the one and only nationwide unicorn lender to help you build your plan and prepare for your future home.
Now, a lot of times people will reach out to me and they won't know what, not only city, but they're talking like different counties or different states. And obviously in that type of situation, you're going to need a different realtor for each of those areas. So when that happens, that's when I end up sending people over to Kelly. A lot of the unicorns work directly with Kelly, but sometimes people come in and they don't know which realtor unicorn they need because they don't know if it's Dallas or Chicago or Seattle. So Kelly, when someone comes to you and let's say they're a year out and they don't know really where they want to live, what can you do with them at that point in their home buying journey?
Oh, so much. First of all, to your point, David, when they point out several different states that they're interested in, typically what we'll do is say, okay, wave a magic wand. Which one, if you could really move there, which one's your favorite? And we'll start there and we'll look at the areas in that state. Sometimes they know, sometimes they don't know. If they don't know what area in that state, we're going to take a very conservative approach at looking at what monthly payments are going to look like based on property taxes for one of the higher cost areas in that state, to give homies an idea of what they're going to pay every month based on their comfort level, what they qualify for. Back to the whole just because you can doesn't mean you should. If you can qualify for a $400,000 home, but you're going to be house poor and eating top ramen, then maybe we want to reevaluate that and, set our sights a little bit lower. But what we do in the initial discovery call is we're going to walk through income. What are the sources of income? Especially if you're relocating, if you don't have a new job in the new area, are you going to get a new one in the same field? Is the pay structure going to be looking similar to the one you have right now? And then we'll build a plan based on the income that you have right now. And then we'll take a look at property taxes for that relatively higher cost area in that state. We'll factor in a basic insurance premium to help you figure out what the insurance is going to look like. We'll ask questions about what your debt looks like. We'll ask questions about your credit score. We'll ask questions about how much money you have saved to go towards down payment and closing costs. And if we need to leverage down payment assistance, that's when the area gets pretty specific. So we'll choose the wave a magic wand area. We'll pick a county or township in certain states, and see what down payment assistance programs are available and work with that to figure out what you need to save, what you need to budget for. If you need to pay off some debt, we'll help you build that plan. Even if it's a year or two out, you are not wasting our time. We are so delighted to help you build that plan and then watch you work the plan. That's when we get chills. Literally, I'm getting chills right now thinking about that. All the great homies that have followed their plan and given us updates along the way. We just got an email today. I just came into $2,700. What should I do to improve my credit score? So we're scheduling a discovery call with that client to discover what kind of improvement we can do with that $2,700 with their credit score, because that's what they're working on. That's their plan. It's a lot. We can do a lot.
That's the thing. When you come into us, you get the whole team, including me. People think my whole day is recording podcasts and then connecting people to... The connecting is just the beginning. Mm-hmm. I have 3 times as many people that I'm doing their monthly check-ins. Where are you on your credit score and your debt and your savings? Your last lease ever 3 thermometers. And when that one came in, she sent the email to you guys because you've already started working with her. And I was like, hey, I don't know. I don't want to butt in here. But if I remember correctly, the credit score that we first saw, could you buy a house with that credit score? Yes. But we go back to what you said. Should you? If you've still got some saving to do after that $2,700, then why not keep saving while you're attempting to raise your credit score? Because that will ultimately lower all the fees as well as open different loan programs for you. So you said so many great things in there. She really just skimmed by, okay, you're moving someplace else. Well, what's going to happen with your employment? There are a lot of times if you have a job in the same industry, you can still get a loan just like you stayed put. So that's why doing these, and Kelly's the one who turned me on to a discovery call, which, by the way, Kelly, I was listening to another podcast for some people and the lender used the term discovery call. And I know for sure they listen to us.
It's
so
trending.
You're a trendsetter.
Let's go, man.
That was a great explanation. I want to get into some nitty gritty details for people here because God knows you and I could sit and talk for hours about everything that you just brought up. The discovery process is such an important part and you're not wasting the time, as you can tell just the way Kelly described it. I've had people reach out to me recently and talking about their loan lock. And I wanted to get your explanation, start with the basics, and then we'll get into the details. What does a loan lock or a rate lock when you're buying a home, what does that mean? How does it work? What are the pros and cons?
Yeah. So locking in your interest rate, this is something that you do once you have an accepted contract. So you find the house, you write the offer, Maybe you go back and forth with negotiations, you land on a sales price, maybe get a few seller credits in there right now. It's still a buyer's market. And then, so we've got a ratified contract, all the terms are agreed upon between you and the seller. It's go time. That is when you're eligible to lock in your interest rate. You don't have to. If you think rates are going down tomorrow and we have an accepted contract today, we can float with the market, meaning the rate could go up, the rate could go down. So once you lock in your interest rate, you're locking in a worst case scenario. Like, yes, sweet, we can count on this interest rate as long as the house appraises, has to appraise, right? No terms change with the contract that change the terms of the loan. There's a lot of different factors that go into the different interest rate you get. How much money are you putting down, if any? What's your credit score? What kind of property are you buying? In this audience, you're probably going to buy a house you're going to live in, or a condominium or a townhome that you're going to live in. But, the next home, if you're still listening, homies, after you bought your first home, might be an investment property. You'll see the rates are a little bit higher there. So what changes with interest rates on a day-to-day is whether you have to pay points or not, and how many points you have to pay. What are points? Points are fees that you pay upfront for a lower interest rate over the life of the loan. Sometimes it makes sense to pay points. Sometimes it doesn't. And whether the answer to yes, it makes sense to pay points changes day to day. It could even change hour by hour. So it's virtually impossible for you to know what the rates are at any given time because there's so many different elements that go into the interest rate. But back to locking in the rate. You are eligible to lock in your interest rate once your contract is accepted. We'll schedule a follow-up call. We call it a next steps call, where we're laying out what to expect now that you have an accepted contract. You're writing that earnest money deposit. What's an earnest money deposit? You're putting up a little bit of money. You're putting your money where your mouth is for the seller, saying, hey, I'm going to put up my $1,000, $2,000, $10,000 here. And while we're going through our due diligence period and making sure the home is worth what I'm paying for it, and my inspections come back clean, that's your earnest money deposit. We're also talking about whether you want to lock in your rate and what kind of payment you want. How long do you think you're going to be in this house? Do you need to do any renovations to this house? If you need to do renovations to the house, maybe you don't want to pay points. So let's talk about this. 1 point is equal to 1% of your loan amount in hard greenback dollars sunk cost cash. So if your loan's $200,000, 1 point is $2,000. If that $2,000 would go further to renovate that bathroom in, the third bedroom or, down the hall, then maybe we set that $2,000 aside and take a slightly higher interest rate. How much higher, you ask? Well, that depends on the day. Sometimes 1 point will buy you 0.25% off the interest rate. Sometimes it'll buy you 0.5% off the interest rate. Sometimes it's not worth it because it'll only buy you 1/8 of a point off the interest rate. Then we take a look at, okay, with that reduced interest rate, how does it reduce your monthly payment? If it reduces it, let's say $200 by paying a $2,000 fee, that $200,000 loan, 1 point, $2,000. Let's say it reduces the monthly pay. It's not going to be $200 for 1 point, I'll tell you, on a $200,000 loan. But let's just say it reduces your monthly payment by $20 a month. Okay. That's not worth it. You take $2,000 divided by $20 a month, that's 100 months. No, way too long to recap those closing costs. So you can see it. Maybe you keep the $2,000, renovate the bathroom down the hall, and take the payment that's $20 more. And then the next home, we have the same dialogue. We decide how long you're going to be in the home. Do you need that money for renovating the property? So it's a different discussion with every property on the day as well.
I tell people all the time that, when I have the discussion about 20% down versus 10% down, and people are have heard you never want to do less than 20% because of that terrible PMI. And then we calculate the PMI and it's $109. They're buying a $400,000 house. I'll say, well, so if let's say it's going to cost you an extra $250 a month in loan because you're getting a larger loan at 10% versus 20%, and $100 in PMI. So we'll call that $350.
Mm-hmm.
If you go from 20% down, which is $80,000, to 10% down, which is $40,000, for the $350, you're loaning yourself $40,000 that you get to keep in the bank for a cost of $350 a month.
Which would
Just
take
like you would be-
114 months, David. Sorry to interrupt you. It would take 114 months to come up with that 40 grand.
And I don't think people understand they have smaller options like you just explained. Everybody's so focused on the rate, and I'm going to get into that later because there's an entire subreddit that I want to take my computer and put a virus into because of what the misconceptions people are creating. When you're trying to figure out what your rate is, there are so many different variable factors with it. Now, and like in your scenario, you loan yourself $20,000 at a cost of $20 or $2,000 for a cost of $20 a month. If you're buying a home where you want to fix a little something, that makes sense. Or if you just want to feel comfortable. Now, we kind of glossed over it, and this is the question people get to me all the time. I don't want to call a lender yet because when I do, they're going to run and get me a pre-approval, and that rate is only good for 90 days.
That rate is not good for 90 days.
Okay. Myth busting time. Go.
Yes. Yeah. So when we run your credit, and depending on, the initial discovery call, we're going to decide together what kind of credit we want to run based on your readiness and where you want to live and how much you want to pay on a monthly basis. Once we figure out what your plan looks like, then we complete the application and we decide whether we're doing a hard or soft credit pull. But once we give you a
soft pull, I'm interrupting you because I just want to make sure everyone heard that. Soft pull isn't a credit hit.
No.
If I have more people that come up to me and say, well, I haven't talked to a lender yet because I don't want a credit hit on my credit score. Most of the time, the people who do that are the people with 820 credit scores that even if they got a 3-point credit score hit, they would still not jeopardize their A++ rating to get a home loan. But what you're saying is after an evaluation, you're going to decide whether you're going to do a soft pull or a hard pull, which is only a few points. And that's how you decide when you're going to move forward. So then now get into what is the myth behind, I don't want to call a lender because if I do today, I might not want to buy for 6 months and my loan approval will expire.
Well, that's great. I mean, that's great. We don't have to start all over again. All we have to do is refresh your documents, get new pay stubs, W-2s, if it's this time of year, which is the beginning of the year at the moment.
Yes, it is.
Bank statements. We'll repull your credit after 120 days, but the rate is not good for 90 days. The rate is not going to be locked until you have an executed contract. There are programs
Say that again.
The rate will not be locked. The rate will not be eligible to be locked until you have a ratified purchase contract, meaning the seller agrees to your terms and it is go time. That's when you're eligible.
So this whole 90-day thing is pointless.
It really is. It's simple enough to update bank statements and pay stubs. It really doesn't matter. I will say this. Let's talk about hard credit pull versus soft credit pull. Soft credit pull is really great for if you already know you have a 560 credit score and you're doing what you can to fix it and you're already making progress, but you're just not ready for us to hard hit your score because it's going to be a hard hit and you're already working from 520 to 560 and that's a lot of progress. We don't want to impact that. So we'll pick a single bureau soft pull. So we have a clue of what's on your credit report. Now, here's the trouble with soft pulls. It does not always reveal everything that's on your credit report. So it's important for you to know, annualcreditreport.com, free, once a year. You can go and pull that. Don't buy anything, by the way. They're going to try to sell you stuff. It's free, but they're going to try to sell you stuff. Don't buy anything. But that's going to show you what's on your credit report. And then when I do a soft pull or somebody on my team does a soft pull with one credit bureau, it's going to show us what's actually showing on that bureau. We're going to go over it with you, and you're going to tell us whether there's anything missing from it. And then we'll factor that into your debt to income ratio. We've had some unwelcome surprises issuing a pre-approval letter with a soft credit pull, because when we go to do the hard pull, once you have an accepted contract, surprise, now you don't qualify. Yeah, we don't do that. We don't do that. We issue a pre-approval letter with a hard credit. That is the only way for us to give you certainty and give you confidence while you're out there shopping for your home and negotiating you'll go back and forth. If you offer 300, it's listed for 350 and they want 340 and you go 330 and they settle on 325, you're going to have confidence you can go to that 325 with a hard credit pull. With a soft pull, not so much, because that surprise could come. You have to have a really good handle on what's on your credit report for you to have confidence in that space. If you have a pre-approval letter with a soft pull, a lot of lenders will issue a pre-approval letter with a soft pull. We only had to learn that lesson once. We give you a pre-approval letter with a hard pull. It gives you confidence and certainty.
And the big picture for me is there's so much focus on hard pull, soft pull. There's so much focus on, I'm not going to call until 90 days out, which you just busted that myth. You can't get your rate locked in until you put an offer on the house anyway. So
and it's accepted.
It has to be accepted, correct. So what's very exciting to me is that you have been helping the homies. And like I said, I get up every day and I'm looking at, here's a monthly check-in for someone who came to us, March of 2025. And we've watched the credit grow. We've watched the debt reduced, but not all of the debt reduced, because they also wanted to continue to grow their savings. And based on them getting coaching from you guys along the way, they knew how much debt to reduce and how much saving they needed.
Yep.
And then as we get closer, either we're connected with a realtor at the whole time, or as we get closer, we connect with the right realtor in the area, and then they start to understand where the budget's going to go. By doing all of this with a team that's willing to do this without any upfront fees or payments from you guys at all, that's where you set yourself up for success. And there's so much overemphasis and worrying about what can happen with the interest rate, where it can actually lock until you get that accepted offer. Now, you said float. Explain that one more time.
Yeah.
So if I lock into a rate and the rates drop while I'm under contract, what are the options?
Yeah. Well, you could pay to buy down the rate at the lower interest rate. Here's what happens when you lock a rate. I mean, we all want to have our cake and eat it too, right? We want to take the risk out of rates going up, but we want the opportunity for, to capitalize if the rates come down. So what happens when a lender locks your rate is we hedge. We promise to deliver that loan at that note rate. Let's just call it 5.99. We promise to deliver that 5.99 note rate for a $300,000 loan. We lock in that interest rate and we make a promise. And when you break your promise, there are consequences. From a lender's standpoint, it's a financial consequence. So what we'll do is we'll share that financial consequence with you so that you don't have to miss out on the lower interest rates, but you're also not having to go find another lender because the rate fell with a tight time frame. That's the last thing you want to do is change horses mid-race. It's going to kill your negotiation with the seller. It's the cake and eat it too piece. Once you lock in your rate, you can sleep well at night, not have to worry about the rates going up. The chances are the rates aren't going to plummet in the 2 weeks you have before we have to send your loan docs out and sign your closing disclosure and get ready for closing, because your loan really has to be locked like a week before you close, because we have to issue a final disclosure showing you your final documents. We have to wait 3 business days after you sign that closing disclosure before you can close. So it's not like I can lock it the day before I close. It's got to be at least a week before. And I'll tell you what, if you don't lock your interest rate, let's say you have a 30-day settlement and you don't lock your interest rate until a week before closing, chances are you're going to be tossing and turning a little bit. The market's been very interesting.
Yes. So in this concept, the first misconception is that if you talk to a lender and you go through a loan approval too early, as it were, and I'm using sarcastic air quotes, you're going to lose whatever rate you had, so you're going to wait until it gets closer. That's not true. Second of all, when you get into it, if the rates in that small window of period, the 2 to 3 weeks, if they do move a little bit, you want to utilize the lock originally and then talk to your lender about potential options if they drop during that time, and potentially doing that float that you described to us. And I think it's a very important point that you talked about, that you will be getting all of these documents well before your actual closing day, or at least your numbers locked in. But it's still not, you're going to get the perfect numbers on the first day that your offer is accepted. Can you please explain that to my, well, let's call them super specific. What I really mean is anal people who are counting every penny.
I'm totally that person.
I know.
Yeah. I want certainty. I want to know those numbers. Guess what? Yeah, we can't always get what we want, right? So here's the thing. You get your offer accepted. It's go time. It's time to order inspections. We're timing the ordering of your appraisal. You're putting up your earnest money deposit. We're finding out you're investing some money with some professionals to figure out whether this home is worth what you're paying for it and whether it's in condition that is acceptable to you. And if it's not, then you have room to negotiate with the seller. That could be for repairs or credits for you to do the repairs after the fact if it's not health and safety related. So in that time frame, we have 3 days once we have an accepted contract to get you your initial disclosures. Well, the settlement company is a disinterested third party representing the transfer of the property from the seller to you through legal means that's recorded with the county or township in which you're buying your property. That settlement agent will give us an estimate of fees when we request it, usually within 3 days, not always, because they're closing loans or deals that came in 25 days ago. So they're working with a pipeline of sellers and buyers, and we may not be at their urgent list. So we have a system that generates estimated fees that are customary for the area where you're buying. We look at the purchase contract and make sure we have all those fees allocated to the buyer or seller as it's spelled out. Each one of those points in the contract is a point of negotiation that your unicorn agent is going to negotiate on your behalf, taking into account how much interest is in this property. If it's been on the market for 100 days, they might have a little more leverage to negotiate the seller paying some fees than if it's been on for 2 days and there's 10 offers, right? So those fees are part of it. And we look at that when we calculate your initial disclosure. So within 3 days of your accepted purchase contract, we're sending you your initial disclosures with something called a loan estimate. By the way, the title has estimate in it. So that gives you a good clue that these are estimated fees. They are not final. There's still negotiations to take place. We also have to factor in any prorated property tax credits that may need to come from the seller for taxes that they owe in arrears. That'll all make more sense when we go through your discovery call. But there's prorations based on the day that you take ownership. And the settlement agent is not preparing that within 3 days of your accepted contract. They're waiting until a week, maybe 2, before you close to give those final numbers because it takes some work and it doesn't happen overnight. So they're all very rough numbers.
Because that closing day, as I say in my closing podcast episode, closing dates are fluid. You sign a contract and it doesn't necessarily mean you're going to land on that day, but that actual date will determine prepayments on everything from HOA to insurance to taxes. And so that will change how much money you need to bring in. People who call up a lender 3 months ahead of time and say, tell me exactly how much it's going to cost for me to buy a $450,000 house, they can't get it to you then. They can't get it to you exactly a month before, and they can't get it to you the day you have an accepted offer. Exactly, they can't get to you. But if you ignore the myths out there and you call and talk to a lender who's going to have a discovery call with you, work a plan, we're going to give you the estimates a year ahead of time. And then as we get closer, all those things can change. So when you're walking someone into an offer, what's the difference between someone who called you because they just randomly went to an open house and the difference between someone who you've been working with for 6 months?
What's the difference in the estimate that we provide them?
Not the estimate. What's the difference in the type of transaction, their, let's call it probability to get an accepted offer or get the best rates? Yes. Someone calls you Monday. We weren't even thinking about it, but my dad used you as a lender. And so he said I should call you and get my pre-approval. And then I'm going to get a realtor and I'm going to go put an offer on that house we saw versus a homie who called you 6, 8, 9 months ago.
Love that. That's great. So a homie that calls me 6, 8, 9 months ago, they're going to have had several installments of education. It's like drinking from a fire hose. That's why you're binging podcasts right now. You're just lapping it up, that fire hose, because you want to know everything you need to know. And what's interesting is this process, there's stuff that develops along the way that there's no way to see ahead of time. So it's pretty cool to have the things you can control under control. So when the roof has a leak and nobody expected that to happen, you're not stressing on whether your debt to income ratio falls into guidelines, if you have to pay off debts, if you're going to get that paycheck in time to have cash to close, if your grandma's going to give you the gift. It is an emotional roller coaster if you wait until you want to buy a house to talk to a lender. You definitely want to build a plan, know what you can do to improve your chances of getting approved, improve your interest rate, improve the costs associated with it. You're going to empower yourself to learn whether you want to leverage your 401k or not. Whether you want to put 20% down or 10% down or 5% down. I've seen this trend, David. Your listeners, your homies are so smart. They're like, yeah, I want to keep that 10% because that's really going to help me sleep at night. And the payment's only a couple $100 more, even with the PMI. Let's just, put 10% down instead of 20. Even when they can put 20, they're putting 10% down because they're educated. They took the time. They scheduled the discovery call. They went through the application process. We scheduled our pre-approval review and talked about different options. If their credit score were 40 points higher, what would that do to their interest rate today? And it's super cool to empower homies to make these decisions before they want to write a contract. It's just, you don't have those options if you want to write a contract tomorrow and we just met yesterday.
I'm so excited with the people making the financial decision. So many people out there, especially the Gen Zs and some of the younger millennials, are feeling like it's impossible. And they're hearing it all over the news. And what I'm telling people is not only is it possible, but there are different financial options that you can discuss with your unicorn lender and find different ways to make things affordable. If someone's like, well, I'm only at 18%, David, I got to save another 2% to get to 20. Then we have the 10% discussion and suddenly they realize, whoa, I got tens of thousands of dollars in the bank. Or someone that only has $5,000 and says, I'm not even close, but they've got a full $50,000 they can pull from their 401k. Mm-hmm. Once you do the math and you figure out the rent replacement strategy, the options become so clear. What I am trying to explain to people more, and it's the reason why I have a difficult time articulating it, is because everything you've discussed with me today, Kelly, these are giant shifts and changes that can happen. There isn't, okay, for a $400,000 home, you need $25,000 and then you're going to get a 6% interest rate. When you're talking about that first LE, the loan estimate, on day 3, it might show that they owe $15,000 in closing costs. But like you said, the negotiations at that point aren't done. What if there's a $5,000 roof problem? That could come back to them as a credit from the seller, and now suddenly closing costs are reduced by $5,000. In that entire process, that's why, I'm assuming that you start at the beginning working with credit score, debt, and savings, but as you get closer and they're getting ready to go, do you start having theoretical discussions with them?
Strategy, total strategy. And every property has a different answer to how long do you see yourself living in this home? Is there anything you want to do to the house that's going to be, an expensive outlay of cash? Should we hold back some of your down payment to do that renovation of the bathroom, like I mentioned? Here's the thing. I want to bring back that $5,000 roof issue. Just keep in mind, there's still a roof issue. So you might be able to keep $5,000 in your pocket, but maybe your uncle's a roofer and it's not a health and safety issue. And it wasn't called out on the appraisal. It just came up in the inspection. Now, your lender typically doesn't see your inspection. We don't really want to. Unless you put it in your contract and you want us to police the inspection repairs being done. If you put it in the contract and you want repairs done, guess who is going to make sure they're done? Your lender.
The people loaning you hundreds of thousands of dollars?
Yeah. Yeah. Based on collateral that needs to be in good condition. If heaven forbid, we have to turn around and sell it. So it's, there are so many different ways to structure this. And what's super cool when you start early is we can flirt with these different options and play around to see what it does to the monthly payment. Like I mentioned earlier, if you go from a 680 to a 740 credit score, that's going to give you a better interest rate. What's interesting is sometimes putting 20% down doesn't always get you the lowest interest rate. Sometimes if you put just 10% down, the interest rate's a little bit lower. Yes, your payment's higher because you're borrowing 90% instead of 80%, and you're paying PMI. But let's say you're expecting an inheritance or you're expecting a lawsuit to settle and you move into the house a year later, you get this flood of money. You can get rid of your PMI, you can pay down your loan, do what's called a payment recast, which resets your minimum monthly payment based on that initial 360-month term, based on that large principal curtailment. It's called a principal pay down, is called a principal curtailment. That is like in the middle of your loan, you're going to pay it down lower. If you kept paying that higher payment, you're going to pay it off sooner, but you could do a recast of your minimum monthly payment based on that large principal pay down that came in the middle of the term, and then have a lower payment for the rest of the term of the loan. You'll pay more interest that way versus keeping your monthly payment at the higher amount and paying it off sooner, which, by the way, can I just throw this in? Paying an extra payment every year is going to radically reduce the amount of interest you pay over the life of the loan. You're going to pay off the loan so much faster. And believe it or not, you can do like 1/12 of the payment as an extra principal payment every single month, so that at the end of 12 months, you've paid an extra mortgage payment and you won't even feel it. You won't even feel it, but you will when you see how quickly your principal balance is going down and how much interest you're going to save.
So this is the thing that is just mind-blowing to me, because these are the discussions that when people work with a strategic financial lending advisor as opposed to an online rate machine, these are the conversations that you're going to have with these people before, possibly even during the transaction, but like you said, it's a whirlwind, but after the transaction. Because I know that you are continually talking with people after the transaction, giving them these tips. Maybe after a year, they're like, I'm going to call Kelly right now. Or you call, check in and say, congratulations, it's been a year. And they're like, we think we're going to move. So the first thing you're going to say is, are you still paying those extra payments like we talked about? Maybe we should start redistributing that into a down payment fund instead.
Yes. And your homies are so smart, David. They ask me these questions before they even buy their first house. It's so crazy, but it's true. Like okay, should we pay down this debt or should we work on our savings? And I always say cash is king. When you have cash, you have options. And a lot of loan programs allow you to pay down debt to qualify. But if you do that before you buy the house, then you don't have the cash anymore to have the option. Yes, you're paying more if you don't, you're paying interest on the debt. So that you have to balance that, but it's an option. It will allow you to buy sooner, or maybe edge you into that nicer neighborhood if you have more cash for the down payment. Now, David, we haven't even talked about down payment assistance. Do you want to even touch on that today or save that for the next
Yes,
podcast?
I do.
Okay.
No, yes, I do. In the fourth quarter of 2025, there were 70 new down payment assistance programs. We're up to about 2,500 down payment assistance programs across the country. So I want to speak to people who have never heard about it, but I also want to speak to some of our higher income people who say, well, that's not for me. I'm not even going to ask about it. Go.
Yeah. In high cost areas, let's start with the people who think they don't qualify because they make too much money. Let's just start with congratulations. That is a very high quality problem in our first world. That said, in high cost areas, let's take California, for example. The CalHAFA program, you can make over $300,000 and still qualify for down payment assistance in high cost counties. It's insane. It's because it's so expensive to live in California. There's other areas where if you go over 80% of the area median income, you will not qualify because they're lower cost areas. And those programs are designed to help even the playing field and allow lower income individuals to get into a home. One thing I also want to mention about down payment assistance is you really do need to have decent credit to qualify for down payment assistance with the county-specific down payment assistance programs. But those aren't the only down payment assistance programs. We have a zero down program that allows for credit scores as low as 600, where you don't have to put any money down. It's with an FHA first mortgage and a down payment assistance loan in second position. Let's get a discovery call booked, and we could talk more about whether you qualify for that and what it looks like.
Wow. Yeah, because I know that sounded like Greek to some people. Of course, I know what it means. But the point is, not only should you check on these things, and the couple who called you Monday morning because their dad did a loan with you and they didn't listen to their dad and they didn't call you 6 months earlier, there's no way for them to apply and go through all that and figure all that out in the time it's going to take to get an offer in. The people who have talked to you earlier, you're going to, and that's so great. I bring you on, we're talking about stuff, and you're like, hey, let's talk about down payment assistance. Because everybody should have this discussion months and months ahead of time because it's potential for free money. And we've had a bunch of people that have stacked them. They haven't used just one, they use multiple different down payment assistance.
Yep,
and
one for down payment, one for closing costs.
Yes, it's such an incredible part of, so as I said, you and I could talk for hours. We're just scratching the surface on all of these multiple different variables in our equation that can change the answer to the question, how much money do I need? Which seems to be the question everybody asks. And what I'm seeing lately is they're tying the answer to that question to the one tangible thing that they feel like they have some knowledge on, and it's an interest rate. The subreddit for first-time home buyers right now has people posting a picture of the house they bought, and then it has the price and the interest rate. And it's like, woohoo! And it's a competition to see, I got this house at this cheap price, and I got it at this interest rate. And I'm looking at it going, did you pay any points for that interest rate? Was there a potential better option for you? I know Kelly and I have worked with people that ended up going with a higher interest rate because it was better financially for the people's long run to fit all their financial and personal long-term goals. What do you say when people are obsessed? I would say focused, but I talk to these people every day, obsessed with the interest rate.
Yeah, well, it's an interest rate tells part of the story. Let's see what their cash to close look like. Let's see if there's any prepayment penalties. Let's see if it's a fixed interest rate. Is it a 15-year fixed or is it a 30-year fixed? Or is it an adjustable rate mortgage where the rate's only fixed for 5 years? It does not come anywhere near close to telling the whole story. It's totally opaque. There are so many facts missing. Okay, Yahoo. What's the rest of the story? Subreddit.
I think the big piece in there that a lot of the people are not understanding about is that what were the fees involved with that? I just explained APR versus your interest rate in a couple episodes ago, but a rate is a number, and most of the time when you're working with a quality lender, they're going to get you that great number. And if the rates drop before you buy a house and you lock into that rate, you're going to save money. You're going to save 100 times. Well, okay, that's a ridiculous hyperbole. You're going to save a lot more money than a quarter point when you work with a discovery call months ahead of time so you can learn all your options. And to me, it's so exciting when there's someone who comes over to you guys and then they'll come back to me later and be like, wow, I had no idea I was this close, because they're still believing the old myths. When someone comes to you and they're closer in this market right now than they thought they were, we never push anybody into a sale, but what's your advice to home buyers who think they might have a little bit to go as we're going into 2026? Where does your team see, with the activity we've seen so far, the market going this year?
Yeah, this window is closing for buyers to be a buyer's market. I will say that. If rates drop and drop and drop, the people who are locked in are going to start competing with you to buy these homes for their grandkids or their kids.
The sellers who are locked in.
Yes, the sellers, excuse me, the sellers that are locked into interest rates who've been sitting in this house for 10, 15 years, wanted to move 4 years ago, but couldn't, or 5 years ago, but couldn't because the COVID frenzy had people offering $100,000 over asking on a $500,000 home. Now, some of those people can't sell those houses now. And that's because it really is a buyer's market right now. Even though it's limited inventory, there's people sitting on these 3% interest rates who want to move, but they need a 5 in front of the decimal point for longer than 36 hours to put their house on the market and sell it. So when that happens, the inventory will pick up, but the buyers are going to come out of the woodwork. They have been sitting on the fence for years waiting for this to happen. You're going to have a lot more competition. So I don't want to press anybody to do anything sooner than they want to. This is your journey. We are on your journey. We will advise you of what the market conditions look like and when it starts to become more of a balanced market between buyers and sellers and when it flips into a seller's market again. So what I'm advising people now that are close is, okay, what do we need to do to get there? Let's go see what it's going to take to get there and how long it will take to get there. And start looking now, because we know what we can do now and we know what we could do 6 months from now. So get out there, start looking. If you see the house, believe it or not, you're probably going to, then you know what you can do now. Or, we're seeing a huge transfer of wealth right now, David. There are so much pre-inheritance. It's something I think that's glossed over or not even considered in a lot of cases. I call it a living legacy, where we're seeing parents and grandparents giving inheritance before they meet their maker so that they can see their hard-earned wealth that they've accumulated over 60, 70, 80 years in the pleasure of their grandkids and their kids' eyes, and help them get a better lot in life, help them start growing their net worth sooner while they're alive before they pass away and don't even get to see it. So it's been fun to see the more mature generation open their eyes to a living legacy or a pre-inheritance. And it totally works with a loan. We're seeing more and more of it. So those conversations are good to have early versus when the house comes on the market, you've got to have it, but you're 10 grand shy and you don't want to have the conversation with Granny about a $10,000 gift. So it's good to have those dialogues soon. What we've been doing for a lot of these folks is showing them side by side. Here's what happens if you put 10% down. Here's what happens if you put 20% down. Here's what happens if you put 30% down. Now go show that to Granny. See what she has to say about that monthly payment and how she wants her grandchildren to scrape by every month. I don't mean to make this a kitschy comment. It's legit. Your family want you to succeed. So if they've got the means and they're planning on giving it to you anyway, it may feel awkward to have the dialogue, but you don't know really how awkward it'll be until you have the dialogue. And I promise you, they'll still love you if they won't give you your pre-inheritance.
And, I do it every Thanksgiving. I give people a new script for each year on what to say to your parents and grandparents and aunts and uncles around the Thanksgiving table to ask for money. And I set people up so they can look serious and like they've researched it to try to surprise them into just opening up their wallets. One of the things that I think people don't get enough in the industry, the statistics just came out for realtors, and 71.1% sold 0 homes last year, and 14.9% sold less than 4. So that means 86%, with most of them selling 0, sold 4 homes or less. I think people are looking at their lenders like a grocery store checkout, and they're just looking for the shortest line based on the interest rate. But what's really exciting to me is when we have someone listening to the show, they're looking in a neighborhood that's a $400,000 neighborhood, and they come to your team. And we work for a few months, and at the end of that few months, it's like you're only approved for $300,000 based on your income, and we'd have to spend, and then we figure out it would take months and months and months to reduce the debt. And then they will email back, "This sucks. Well, we tried. We're sorry." And you're like, no, we're not done. This is the starting point.
Mm-hmm.
I wish more people understood that when they go to the right lender, If the answer isn't what they're looking for, your next step is to help them create a plan to get there.
Correct.
When somebody comes in a situation, well, I don't want to put you on because they're all hypothetical and they're all different. But you're always so good at helping people understand what their options are. When you finish your discovery call with most of the people, what are the next steps at that point that you're wanting to do together as a team?
Yeah. So we finish our discovery call and we decide what's next. Is it time to apply for a loan? Is it time to do the soft credit pull? Are we ready to do a hard credit pull? In that initial discovery call, a lot of people are ready for a hard pull because they want the certainty. And we prefer that too. We like the certainty. The worst thing we could do is a soft pull. People get all excited and they go find a house and then we do a hard pull and we pull the rug out from underneath them because we didn't do the hard pull to begin with. So your lenders love a hard pull. I'll tell you that. So, but it's also, we're not going to push you to do it before you're ready. And we're certainly not going to do it prematurely when you're working on your credit score. So we have our discovery call. We decide, let's say we're going to complete an application. We'll either complete it right then and there if we have time, if we're not stacked with appointments and you've got the time to do it over the phone, or we'll send you a link. Most of the clients want us to send a link. They could do it in their own time when they've got their pay stubs, W-2s, and can take time together to do it. Or if they're on their own, they do it after work. We're notified that the application has been submitted. Once a client submits the application, they go in and start uploading pay stubs, W-2s, bank statements. Once we have all that documentation, now we have the goods to figure out how to put this puzzle together, have all the pieces. And then once we do that, we'll schedule a rediscovery call or a pre-approval review call. If it's a rediscovery call because we've got a plan to create, then we're creating the plan. And then we have an awesome client relationship management tool where we schedule tasks for ourselves, literally years in advance, to follow up with you every single month to see how things are going with your plan. And we expect you to respond to us to let us know what's going on. And guess what? Life happens. Cats get sick and you get $1,000 vet bill and you're set off plan. We are not mad at you. We like to know that you're going through life too. So are we, right? This stuff happens to us too, but we're there to catch you and help you catch up. And, maybe we push the plan out a couple of months. Maybe we were going to close by January 27. Now we're closing in March 27. Because, I don't have any humans. I only have fur babies. And if they need the vet, they're going to get the vet. So, and I know a lot of you are in the same position. So we just love to be part of your journey and part of your plan. And we don't just love the planning. We want to go through the process with you. When you write a contract and you get it accepted, we want to actually hold your hand through the entire process. We do offer this service complimentary, but ultimately we're setting ourselves apart by investing in this relationship with the hopes of closing this loan with you. Sidebar, real estate agents, David, myself, none of us get paid until we successfully close the deal. Now, we're not going to push you to do it before you're ready. We do this for a living. So if we're not vibing, totally cool. Most everybody loves our vibe because we put so much energy and effort into the education. That's why I'm spending my time here with David to help, peel back the onion. It is a legitimate process. And one phone call is not going to prepare you to buy a house. There's going to be multiple phone calls.
Understanding that you're working with a strategic financial consultant, not just a checker who's going to take your application, throw it through a machine and give you an interest rate. That's what's going to change your trajectory as a home buyer. And Kelly, I appreciate you taking the time. I'm sure you have emails and phone calls right now of people who are excited to ask you about their next questions in their home buying journey. But you're taking the time to do what I've been doing here since 2019 and give this information to all the people out there. I appreciate you breaking the mystery of the loan lock. And gang, wherever you are, whatever you're doing, I don't know how to be more clear except to say that you have the option to start early and set yourself up for something better. If we're not vibing, we're not vibing. But what have you got to lose? Because you could find out, like so many people do that reach out to us, that they're in a far better place. I guess I'll leave it with this. Hey, Kelly, what's your response to all the talk about the Fed and the government and housing and all that, should people be waiting for interest rates to magically drop to 4.99% by the end of the year? I know the answer. I just want to hear you say it.
Yeah. Heavens no. Heavens no. Because it's not going to happen. I don't know.
Heavens no.
Maybe it will. Doubt it. Highly doubt it. As a matter of fact, but you know what rates are going to do? Let me do this, David. You know what rates are going to do? They're going to come down, and then they're going to go up. And then they're going to come down, and then they're going to go up. And then they're going to come down, and then they're going to go up. Housing prices, sure, we've seen a little softening because the COVID people paying $100,000 over a $500,000 price. You know, they paid more than they should have because of the demand in the market. But the values have gone up, 30-40% since 2019, David? And with the inventory shortage and when rates start coming down, these values are going to start climbing again. The rates may go up and down, but over the long term, real estate is a long-term hold. The value will continue to go up. History shows it. Go look at the stats. Ask your AI. Values on real estate will continue to go up.
Go ahead. And by all means, please ask your AI, because one of my friends called me and said, I asked AI for help for a first-time home buyer, and it said David Sidoni. And they were like, what? And then they called me. So go ahead.
Ask your AI.
I appreciate it. It will go up. In general, I don't see enough movement this year, one way or the other, with interest rates, that waiting is going to be a magic salvation for anybody. And if you go through a discovery call and then you go through the next discovery call, forgot what it was called, Kelly, sorry. And then
rediscovery or pre-approval.
Rediscovery call. Yeah, okay. That's on me.
All the things.
When you're doing that ahead of time, you have the options to not only decide to put a pause on it because life happens or it's not working out for you. Most people discover through the discovery period that there are options that they never even dreamed of. So thank you so much for your time, Kelly. I appreciate it. And the homies love you for coming in and dropping your knowledge.
Super grateful for the invitation, David. And thank you for your trust. We love working with your homies.
Awesome. Thank you so much.
Thanks for listening to the How to Buy a Home podcast with guest Kelly Cort. If you're looking for free resources for how to buy your first home, check out howtobuyahome.com. We've got tons of episodes just like this, including interviews, best practices, and a whole series just based on the vocabulary of real estate, so you can learn anything you need to know about your specific home buying journey. Also, we've got new AI tools trained specifically on our accurate database of first-time homebuyer knowledge. That's all the podcasts, consulting calls between David Sidoni and first-time homebuyers, and all of the notes and research David has taken over the past 20 years as an expert first-time homebuyer advocate. So if you're looking for the #1 resource for first-time homebuyers, check out howtobuyahome.com. And remember, you can do this. Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyahome.com to get started.